Welcome to Money Hangout once again. Every week we talk about something which is top of your mind. We try and help you understand mutual funds better, and we also try and take as many questions as possible on a certain area. Today we are going to talk about the anxiety that we are all facing, and a lot of us are actually happy, a lot of us are very disappointed, a lot of us are really worried. So this is about the Sensex touching a new high of 30,000. It is close to that even now. How much should you worry about it? How much of it, you should celebrate? And how to deal with it, given your situation, circumstances. I'll just set a roadmap in terms of how to approach this. A lot of investors, whenever they have been excited about markets, investing in equity market, they have been generally disappointed. So being concerned about it is nothing new, I think, and that is the nature of the equity market. That is the nature of the equity fund. When the going gets easy, it generally becomes disappointing, and that is how it has been in the last 20-25 years. Whenever Indian investors have gotten excited about equity, they have been disappointed thereafter. But how much to worry and how to deal with it? Because going by what has happened in the economic in the financial markets, in the economic environment that we live in, not investing in equity is not an option. Interest rates are coming down, and we are also going to live longer. One has to invest in equity, and equity will always be scary on many occasions. When it becomes very cheap, it gets very difficult to invest because it can get cheaper. And when it has achieved a new high, it has become scary that it is all well poised to correct. So broadly, there are two kinds of investors, and their concern is different. One set of investors are the ones who are already invested. They are carrying on with their plan, or they have invested and their investments have done very well, and they are getting worried that if the market corrects and corrects sharply for a prolonged period of time, they will be faced with losses, or a lot of gains that they are sitting on will get wiped out or get reduced substantially. What they should do about it? One is that I don't know when the market will correct. I don't know if the market will correct. I also don't know that what will lead to a market correction, because there are a lot of variables. And in the market, in the equity market, it is never generally one thing. It is a combination of few things which leads to a great deal of turmoil. One small thing, two small things coming at different pace of different period or different point of time, it may not have a devastating effect on the market. Yes, if 3-4 bad things happen together, markets can see a disproportionate correction or for a prolonged period of time. But I don't know what they will be, what will drive that. One thing is certain, that a good part of the market is not looking very cheap, and at the same time, a reasonable part of the market may still have a lot of upside, because there are great companies, there were undiscovered companies. There are a lot of companies in which a completely new market has been created over the last 4 or 5 years by a lot of investors pouring money into mid and small cap funds, multi-cap funds, which are finding that has led to discovery of a certain segment of the market which was just not there before. So I would say that guessing all this is hard, but in 2-3 kind of situation, in 2-3 kind of circumstances, you should have a plan and you should implement it even now. One is that, do you have an asset allocation plan? Have you set out to have 70% into equity, 30% into debt, or 50% into equity, 50% into debt? If you have set out with an asset allocation plan, depending on your comfort level, then your asset allocation would have become completely wacky. It would have become very different from what you set out to do. So your 50% in equity would have become 70% into equity, because fixed income has gone steadily, but equity has gone far more dramatically. So getting a 40% return on your equity will actually make that 50% look like 70%. Take out that 20%, put it in fixed income, restore your balance. This is one way of dealing with this. The other way of dealing with it is, if you were investing with a goal in mind, take your money out if you have come close to achieving that or actualizing that goal. If you're planning to buy that car or making that down payment for your house, and you thought that you will do it over the next 3-4 years or 5 years, and you have been lucky with the market, take the money out. There is no greater satisfaction and financial success than meeting the goal with your investments, which you had planned for. And if it has happened, if you can prepone it, if it has happened then earlier than you planned for, take that money out. Rest of the of investors, and after you have done these two things, I think it is important to stay the course. Your long-term money should be in equity. You should never be investing lump sum money. Don't get greedy about, if you have some lump sum money, try and invest it at one go. Don't do that, because this is a kind of situation where a big correction for a brief period of time, and once you have invested lump sum, can drive you out of the market and will make sure that you will be forced out of the market. You will never come back again. So keep away from that, and that is the reason why a lot of investors actually keep away from equity for years to come. So be methodical about it. Take things in your stride, and maybe if you're a long-term investor who is carrying on with his SIP, and even if you have lump sum investments to be made, just bet on the SIP. Be regular about it. Be disciplined, and celebrate when the market corrects, because that is the occasion when you will be able to invest cheap. Then there are other set of investors who are disappointed with this market surge because they have been waiting. They have been waiting and expecting the market to correct, and they have been expecting this for 2-3 years. It has not materialized. In fact, it has achieved a new high every few months, and in a fairly steady manner, despite all the concerns about the kind of companies, the stretched balance sheet, the NPA problem. We have seen from the worst of news, we have seen some of the biggest surge. So for those investors, I would say that get little conservative, be conservative, choose a more conservative vehicle to invest, but get started now. And so if you have 5 lakh rupees, 10 lakh rupees, and you were thinking that you will invest at some point if the market corrects, and then if you are making up your mind to invest over the next 12 months, maybe spread that money over the next 24 months, but get started now. You are putting 1/24th of your money today and doing it over a period of time. You will be able to average. This is the only way to actually get, tiptoeing into the market and getting onto a plan, because if you keep thinking, keep worrying, you will never on board, you will never be able to swim. You will just stare at the water, worry about how cold or hot it is, never get going with that. And being in the market is just as important. Work on a plan, get and execute it. So I would say that all the set of investors, they should celebrate. At the backdrop, the core thing is that you are investing your long-term money into equity. You are not speculating. If you are investing for 1 year, next 18 months, equity is a very dangerous thing. There could be occasion when it could be very disappointing. Don't never invest your short-term money into equity, either through funds or equity shares directly. If you are investing your long-term money, this is the plan to follow for the investors who are invested and the investors who have been thinking.
Thanks, Dhiren.
Thank you.
Based on our questions, with the Sensex touching 30,000, investors do seem to be a nervous lot. First up, Ashwin says that the Sensex got close to 30,000 last year. So does the fact that it is at the same level now mean that it is undervalued?
I don't know. Something being attained in the past doesn't mean it is undervalued or overvalued, but a good part of you look at the Sensex and it is back to 30,000 in a year's time, or getting close to that, was close to that last year as well. But the underlying component of the Sensex have changed very differently. There are companies within Sensex which have done very poorly. There are companies which have done exceedingly well. Look at the State Bank, which was a sizable part of the Sensex, or look at Reliance Industry, which after its struggle for last 10 years just went up by 35-40%, or State Bank, which has gone up by 50% in the last 1 year. So there are components within those 30 companies of Sensex. There are companies which have done exceedingly well. There are companies which have struggled, and there are companies which have done okay. And that is how any average is made up of. That is what happens in a classroom of 50 students. That is what happens in a collection of 50 companies or 30 companies here. But and a good part, I can tell you that a good part of the Sensex was relatively cheap. And today, given the situation, some part of the Sensex might still be cheap, but it's a matter of the outlook. Somebody is scared of investing in a set of companies in Sensex even today, and that is the part which has become cheap. So everything is relative. Don't worry about it. Stick to your plans. And the kind of difference that we see among Indian equity fund, the actively managed fund, the fund which are managed by fund managers who are taking a call in terms of what to avoid and what to actually overweight. Even among the large cap funds, there is a substantial value addition. Looks like adding value substantially has not been very difficult for Indian fund managers, and there could be a variety of reasons for that. So I would say that things remain the same. Yes, things may not be as cheap as they were a year ago.
Next up, Mr. Bhatia asks if he should shift from mid-cap funds to arbitrage funds given current market conditions.
No, don't do that. It's a very knee-jerk reaction or based on your perception. Markets can continue to go up after you have taken your money out, because moving your money from equity to arbitrage fund primarily means arbitrage funds are nothing but a liquid fund which gives you the tax treatment of an equity fund, which means you hold it for 1 year and all your gains become tax free, but it is going to yield returns, generate returns, which will be close to liquid funds, 6.5% max. This kind of move can actually drive you out of the market, and once you get out of the market and market goes up by 10-15%, you will not be able to come back again. I would say that for this reason, the kind of concerns that you have in your mind, exactly for this reason, one should start with an asset allocation. If you don't have one, set out one, craft one, articulate one. Decide that whether you want to be 50% into equity, 50% into debt, or 70% into equity, 30% into debt. This way, you will be able to make sure that whenever market goes up substantially on one side, because one is to take money out of equity, the other is to move money back into equity whenever things change dramatically, because over a period of time markets will swing in both directions. And having this asset allocation policy for yourself will make sure that you are buying cheap and getting out when things get expensive, and you are never completely out of the market, or the way you are thinking, because this could translate into huge disappointment. There is a small possibility of a big bonanza, but it may not be worth it if it is your long-term money which is likely to remain invested for many years.
Moving to a slightly different topic, Mahesh says that mutual funds have been allowed to invest 10% of their assets under management in real estate investment trusts and in infrastructure investment trusts. Will this affect fund performance?
These are relatively new investment avenues enabled by the SEBI, by the stock market regulator. And so every fund company has been allowed to invest up to 10%, 5% in each of them. But they are relatively new. There are not too many options. I have still concerns about the kind of liquidity that they will evolve. Some of them might do well, but these are early days. I don't think too many funds are going to invest 10% of their money in these two investment options, till they see that the market has evolved, or they see a medium-term, long-term opportunity, or they are assured of the liquidity. And it may not be very liquid to begin with. So these are early days. It can lower the return. It can also enhance the return. There is a possibility that somebody who is going to venture with a new set of investment avenue, it might translate into bonanza for some. This is where we entrust our. This is why we entrust our money to an active fund manager who will take a decision on whether to invest or not. But anyway, if your investment, only 5% of your investment is to be invested in InVITs and REITs, the real estate investment trust and infrastructure investment trust. So early days, and I don't see too many investment options right now, and we'll see as they come. It can translate into a bonanza and disappointment as well.
Staying with the subject of real estate, Mr. Roy asks whether he should consider his real estate assets as debt or equity while calculating his asset allocation.
I would say that this is a question which was which has been addressed by SEBI for the real estate investment trust. And I would say that you should consider your real estate investment as a hybrid investment, because if it is put on rent, you will have an income from it. And the assumption is that over a long period of time, the price will also appreciate. So it has the nature of an equity as well as fixed income. And if you are going to live in that house, if it is not an investment, then it is a home. And in a way, it is just an income. It is not an, you are not looking at it as a capital asset, because you are unlikely to be selling it anytime in future. But in that case, it just remains an income avenue, because it is saving your rental outflow. So depends. If your house is an investment, then it is a hybrid investment. It has nature, components of equity as well as debt. If you're living in that house, then it's just saving your income outflow. So I would look at it as an income avenue, income avenue, which is substituting your income outflow.
Next up, Ashish asks if there is a way to check the rating of funds for each year since inception.
Not right now. We have the history of all the ratings since we started rating Indian mutual funds since 1993. A lot of funds which we used to rate in 1993 don't exist, but ever since we started rating, we have all the history. We will have a new version of our website coming in a couple of months, and that provides for having this, it will have the provision of the historic rating of mutual funds.
In our next question, Ramesh says that when you reach the top, the only way is down. This is what history suggests. So what should what should he do in terms of investing a lump sum in equities at present?
I don't quite agree with him, because market has, if you look at Sensex today, what we are talking about right now, in 38 years since it was crafted, the Bombay Stock Exchange sensitive index, it has gone up by 30 times in 38 years. So that is quite a jump. And market touched a new high when it turned, when it went up from 100 to 200, from 200 to 400. In 1992, it touched a new high around the Great Indian Scam, from 2000 in 1990 to about 4000 in 1992 by the month of May. So it doubled in that time period. Likewise, for many years the market drifted, everything changed. Foreigners were allowed, a lot of things happened, the economy was liberalized. And today we are at 30,000. I don't know. In 2008, the market was at 20,000. I don't think that, this market going up on the Sensex by 50% from a high of 20,000 in 2008 till 2017. This is not an extraordinary return. But there are internal, a lot of Indian investors who have invested in mutual funds or who have invested in a different set of stocks. Their return will be very different. Many funds have actually multiplied investors' money every 3-4 years, even during this period, which means in the last 8 years there are funds which have gone up in value by 4 times, while the Sensex has gone up by only 50%. So I don't quite agree. Equity goes up because equities produce, companies generate more, earn more. The ownership gets priced in the market. The product and services created by these companies get adjusted for inflation, and many companies also grow in size over time for their superior product or services or strategy or design or brands or whatever. There are too many things at play, and that is why we entrust our money to a fund manager to do those evaluation, to make that choice and achieve those superior returns for us. So don't get unnerved. Don't have this notion that markets can only correct from a high, because markets can have always, and of course it can correct. I'm not saying that they will not correct, but it may correct, it may not correct. I don't know what will actually cause that correction, whether it will happen in what time frame, or whether it will happen in the first place. So great deal of uncertainty. What I know for sure is that over the next 5 years, over the next 10 years, money entrusted to good fund manager in a gradual way will generate more return, irrespective of the corrections. If you are investing with 5-year, 10-year time frame in mind, you will be better off than any other investment avenue. I don't know how much that return will be, whether that return will be what we have seen in the past, whether it will be more than what we have seen in the past, or whether it will be enough, whether it will be good enough for a lot of people, because a lot of things have changed. When interest rates in this country was at 12% or 13%, which was the risk-free return. You can put your money in an RBI bond 20 years back and earn 12%, 13% return or 11% return. Expecting 20% return from equity was decent risk premium. But if interest rates come down to 6% or 7%, and that is pre-tax, so I just might be happy. I may not be as happy. Things might not be as good as we have seen in the past, but I'll be happy with 12% return. And if inflation comes down to 4-5%, I'll be okay with 10-12% return, which may not look great return in absolute terms, but going by our experience in the past, but that might be quite meaningful for most investors, and most investors will be well off, because all you have to see is your money beating, is your investment beating the index, is your investment beating inflation, and if that is doing it over a period of time, you'll be better off.
Dhiren, some investors are concerned about the markets on the basis of valuations rather than levels. Vishal says that many good large cap stocks have a high price to book ratio. Are they good investments?
There are different companies which command where the book value doesn't matter. There are kind of companies where book value matters. I look at book value for all the banks. When I was, last year, State Bank was available at 33% discount to its book value. There were all kind of concerns about State Bank, the NPA problem, the rising scale of NPA, and even despite the fact, and a lot has happened since then, NPA, we see a decelerating trend with a great deal of optimism, and the merger of the banks. And now we see that suddenly State Bank is trading at a marginal uh, premium to its book value. So for many businesses, book value matters. For many businesses, book value don't matter. They are not asset plays, particularly in case of service companies, for companies where the brand actually plays a role, or something, a company which has some kind of competitive advantage where capital is not at play. So I would say that book value is one of the thing, and it is a very valid yardstick on which many companies should be measured against, and it is definitely a pointer of relative valuation. But book value is not the only thing. There are other variables which one should look at, and that is applicable for different variables for different set of companies, kind of companies.
A commonly used investing strategy is to use a target rate of return. Kanish asks if he should move out of equity and into ultra short term debt funds once his target rate of return has been achieved.
Uh, if it is your long-term investment, and if you have set a target, uh, then the problem is that you will be out of it. I would say that it should be goal-oriented. If you have set a target and you can realize that money, consume it. No, absolutely no problem. But if you have achieved a target, I'll cite you an example. I'll cite you an instance. If you had set a target in 2003, and if you had set a target of 100% return, then the market went up from 2800 points to 5600 in less than in about 2.5 years. So you would have doubled your money in 2.5 years time, which is extraordinary. And if you would have, so despite that achieving that target, and in the next 4 years, market went up by 4 times from those levels, from 5,000 to 20,000. It happened by 2008. So if you set a target, I would say that the method that I have told you earlier, set an asset allocation for yourself, or realize the money if you have set a goal for yourself. These two things will work much better. They are not knee-jerk reaction to, or you will not be a victim of your misplaced belief that you might build yourself, and you start believing in that, or a level of conviction which may not be factually, will may not be based in facts, rooted in facts, or market is a very weird place. A lot of weird things happen. Many a times it is unrealistic, many a times it is realistic, but over a period of time it is definitely realistic. Companies which earn more money, they tend to gain better, over a period of time, and in the short run, a lot of nonsense happens. So ignore the noise, make a plan, and stick to your, stay the course. And once you have done this, ignore. These are the kind of occasion when you should be doing a quarterly review of your investment. Look at your asset allocation, maybe turn little conservative, but that's about it. Don't try and be in or out of it completely, because on the other hand, I come across investors who say that, oh, they have missed the bus and they have to board this quickly. Those are the people who could be in for great disappointment if they go wrong in the short run, and they will be driven out of the market, and they will never be able to come back again. So it's important to be methodical about the way you actually get into the market and be there.
Next up, Krishnan, who wants to retire in 18 years, asks whether his SIP should last for the entire period or whether he should redeem his units after, say, about 13 years.
Depends. I would suggest, Krishnan, there are two ways of achieving this. Having enough. One is to work on an asset allocation as you get towards your retirement. So in the last 2-3 years, you have to do few things. One is that the last 3 years' money, which you'll be saving, if it is put in fixed income, then you don't need to take the money out. That is the short run money, and the 3 years income, the savings that you have in the last 3 years, if you put your money in fixed income funds, that will be, you can take that money out anytime. It will be free from anxiety, and the remaining money that you have accumulated in the first 13 years, that can continue to grow, and replenish that money. The 3 years money that you will be investing in the last 3 years, whenever the market goes up, or whenever you think, every year and a half, take some money out from your equity investments and put that into fixed income. That is a very nice way of methodically. All the returns on your equity investments will be long term. The first in, first out principle is followed when you actually take your money from equity. So it will be completely tax free. The money which you need to consume over the next 2-3 years will be lying in a fixed income fund, which will be not subject to great deal of market risk, very nominal risk, because fixed income is not that volatile, and it can move in a range of 1.5% in the worst of times. So generally speaking, and it is a relatively stable asset class, so you'll be completely assured of your income needs, and this is your retirement income plan, and it can be achieved with great simplicity.
In our next question, Subbu asks if there are any circumstances in which a one-time investment is better than an SIP in equity funds.
Yes, if you have the foresight, if you think, in one situation, if you think that the market will go up dramatically over a period of time, and you have the courage of conviction, you have the willpower, and you are willing to withstand any interim decline, which means you are stubborn, uh, then which means that you are an astrologer or you are a magician, then it will work very nicely. You will be able to buy exactly at the low and wait for the market to go ballistic. And it could have happened. It could have happened with some person who would have invested heavily in 2003, from where, as I was telling you, that market was at 2800 level. That was the time when we launched I remember this level of the Sensex, because in 2003, we launched our magazine Mutual Fund Insight, and that was the time when the only game in town was invest in fixed income fund. Talking about equity fund, because in the recent past 3-4 years, in 2003, equity funds had only disappointed. Anybody who invested in equity funds, in the technology fund, they had lost money. Most mutual funds, the popular ones, 5-7 of them, open-end funds, they were largely investing in three kind of stocks, FMCG, pharma, and technology. That was all there to it. The Indian funds were not investing, they were the primary drivers of performance for these. In fact, our analytical framework was, we used to look at funds and say how much of the money is in the three, FMCG, pharma, and technology, and that, higher in this allocation in these three, and then we saw a turnaround of the economy, and the market went up, and market just went going up. And so I would say that if you are able to do all these things, but it's very difficult to do that, so devise a methodical plan, get started. uh, don't try to do this, and if at all you have, unless you have some distinct advantage, about a company, about something, about, I'm not saying insider information, but you have a belief and understanding, you have some competitive advantage by way of your understanding, then only you should venture that. And then you should have the temperament, because there are only 2-3 ways in which you can achieve this. You have some competitive advantage with your understanding, and you have the temperament, and then you are able to concentrate on some of those things. You are able to have the focus of doing it with 2-3 stocks or 1 or 2 fund which you think will be doing extraordinarily well for a certain reason. If you don't have that, stick to a plan. Maybe concentrate your portfolio, look for the focused fund, look for the relatively risky fund. But I would say that don't get distracted from a methodical plan. If at all you have any such plans, do it with a small part of your money. Don't put your financial future at risk because you think of one such situation.
Thank you, Dhiren.
Thank you.
We now move to our final question for today's hangout. Ruchir Prasad says that if a mutual fund is performing worse than its peers but higher than its benchmark, should he shift out of it?
Maybe, maybe not. And I would actually give that fund some time, depending on the track record of the fund manager. If the fund has 15-year history of beating its peers and beating its benchmark, I would give that fund 3-4 years time. If that fund actually happens to be 2-3-year-old fund, and if it is beating the benchmark but at the bottom of the pack relative to peers, I will not be willing to give it a lot of time. I'll see it for a while, and because my belief will be a function of how many cycles has the fund manager seen, because there could be occasion. There are funds who are able to beat the benchmark, but they underperform the peers for a long period of time, only to make a big comeback with a bang in a 2-3 years time period. But then to stick to that fund, you need to really see how long he has been around, and has he been right on all the past such occasions.
Thanks, Dhiren.
Thank you.
Any final comments?
If you worry, then you'll keep worrying. Devise these simple rules on which you have control. Met your goals, take your money off. Don't have an asset allocation plan, devise one. You will be able to partially de-risk yourself. If you have been waiting on the sidelines, get going with a conservative plan. Don't do this knee-jerk thing. Take my money out only to regret later, maybe and a big regret. Stick to some plan, and if you will succeed with 70-80% of your expectation, that is good enough. Don't try to do a great perfect timing of things. You will go wrong and you will regret. Devise a plan, stick to it.
Thanks, Dhiren.
Thank you.
Thank you all for joining us. Join us next week on our next hangout on another important investment topic.